Welcome to Nasdaq TradeTalks, where we meet with the top thought leaders and strategists in emerging technologies, digital assets, a regulatory landscape, and capital markets. I'm your host, Jill Malandrino, and joining me on the desk at the Nasdaq Market site, we have Maddie Radner, Director on Nasdaq's Market Intelligence Desk, Egilinsky, Head of Sales and Distribution and Alternative Investments at Direxion, Michael Normyle, U.S. Economist at Nasdaq, as well as Gene Goldman, CIO of Cetera Financial Group. It is great to have everyone with us, and loving your notes here, Gene, that the markets are terrified. I like that one. I'm going to hijack that.
Terrified. Thank you.
Yeah. So there is some optimism, though. At the end of the day, we will get clarity at some point.
At some point, yeah. And I think what we laid out for our clients, clearly uncertainty, the tariffs. If you look at tariffs, for example, last time we checked, it was about 26.5% average tariff rate. I know it's come down a little bit given the news, but that's still about 10 tariffs as a rule of thumb. 10% of tariffs are affecting the economy and inflation, so that suggests inflation up 1 to 2%, economic growth down by about 1 to 2%. With that said, though, we're optimistic on a go-forward basis that stocks will be higher by year-end. Valuations, tariff revenues will be used for tax cuts. You look at bearishness, we saw the market move today. The market was so bearish given the RSI, the MACD, all the different statistics, and the fact the Fed could cut rates. We're off the table. We think maybe 1 or 2, but the markets are pricing in 4 or 5 right now.
Yeah.
So some optimism behind the scenes.
And Ed, the environment, I think, it's been shocking. We were joking around on the desk yesterday. It opened up, significantly higher, and we were like, oh, I bet you we're right at the end of the day, being flippant about it. And then the round trip that we saw on Monday,
it's stark. Yeah.
It really is. I'm trying to compare it, to other longer term periods of volatility that we had, whether it was, the late 90s, GFC, 9/11. This feels very different in a way.
Yeah, I mean, listen, you don't know what the catalyst is going to be in terms of what creates that volatility. For our purposes, we have mostly leverage and inverse ETFs. Mm-hmm. So short-term, tactical, active trading type of tools that are bullish or bearish. We're agnostic in terms of the direction of the market. Certainly there's been a tremendous amount of volatility, both to the up and down side, but the intraday swings have been really historic and parabolic. So you really can't leave your screen or even take a restroom break. That's the type of trading that's been going on. We're seeing a lot of activity, though, buying on the dip. Now, that's occurred for numerous days until today, the buying on the dip, but a lot of our leveraged bull funds are seeing heavy activity to them, unprecedented record type of volume, and that's the semiconductors, the tech, as well as some of the single stocks like the 2X bull on our Tesla and NVIDIA.
We were talking about, I'm sorry.
Oh, that's one thing to add. Ed made a great point, how this is different for the past. I think one thing that's important is that you can't look at technicals. Technicals, you have to throw them out, and fundamentals are too uncertain. But I think your products have done a great job in terms of mitigating some of the risk or being a little bit bullish. And we saw some great numbers today in terms of money coming into your products. So.
Right, and speaking of those numbers, we were discussing this yesterday on the desk, 43% of the volume on Monday were ETFs,
yes,
which was the second highest since November 2008. I mean, consider all the products that have been developed since then, but that it does give you some insight into how investors are thinking.
Yeah, I think definitely, and Gene could elaborate on this, a lot of his financial advisors are more strategic asset allocators that are a little bit longer term. And then you have a group of very short-term active traders that are trading the likes of options, crypto, and leverage and inverse ETFs, and are really staring at the screen. Now you're really instantaneous news now with technology and with all the headlines. Look at today, the reversal, for example, as well. So you have to be vigilant when you're trading leverage and inverse ETFs. I'll speak for just us. You need to monitor these on a daily basis, an intraday basis, and you really need to understand the mechanisms of how they work, whether or not they're appropriate for you, because they're not appropriate for people that are buy and hold investors. They're really for very short-term tactical trading.
It's a good distinction. I mean, there's something for everyone here, Maddie. But we're also coming into earnings, right? And I'm curious to see how this is going to play out, because the performance might be in line for the quarter, but what is forward guidance going to look like?
Yeah, the really important thing that all investors are keeping a close eye on is guidance and how they're going to be projecting future earnings and future results. So sales and earnings estimates have been falling rapidly as we have entered the Q1 earnings season. especially for small cap earnings. Looking at the S&P 600, they've had the worst earnings estimate revisions. The earnings growth rate for the S&P is still expected to be about 7% as of last week, so it could still change as we move forward, which would mark the 7th consecutive quarter of year-over-year earnings growth for the index. That is still well below the double-digit growth rate that we expected at the beginning of the quarter. So there's still a lot of uncertainty as we approach this earnings season.
But Michael, removing the noise, and we've spoken about this a number of times, the actual data underneath the surface for the moment remains quite strong.
Right, but it's all backward looking, right? So on Friday, we got a great jobs report, 228,000 jobs added. If you look at the unemployment rate, it ticked up, but it was actually up 0.01 percentage points, and that made it go from 4.1 to 4.2 if you round it, so not actually a big deal there. But so the labor market's holding up through March, but we'll see what happens from then. Earlier this week, we got the NFIB Small Business Optimism Report. They showed their hiring plans are continuing to be pulled back. Small businesses, they employ about half of everyone in the country, so if they're pulling back on hiring, that's going to be a negative for the labor market going forward. And we'll have to see what happens with tariffs. Of course, the big news today being the 90-day pause on the higher reciprocal tariffs on everyone that didn't retaliate. But we still have 125% tariffs on China now, and the US and China, 40% of the global economy, are in an escalating trade war. So that's not going to be a positive for the US.
So, Gene, we kick the can down 90 days. Does the Dow deserve to be up 2,200? Just because we're going to have this conversation again in 90 days.
I think the key thing is to look at some of the technicals. I know I said discount technicals, but you look at the bearishness in the market right now, and you saw the rumor that came out on Monday, stocks surged. They were ready to pop, and I think the news today takes a negative part off the market a little bit, saying, hey, maybe President Trump under pressure from the billionaires, under pressure from companies, under pressure from the economy, the markets. Hey, maybe I need to rethink this. And I listened to Besant this afternoon, and Besant said this was the plan all along. I'm like, okay, maybe it was, maybe it wasn't, but regardless, this was the plan. So I think finally there was some uncertainty about the markets and the economy that said, let's pivot a little bit according to.
Yeah.
And I loved your comment too about the economy. We think the same thing. Last week, the firepower was pretty strong coming out of the employment report. It's going to slow, wages are going to slow, the economy is going to slow, but it's solid that we feel that we're coming off of a very solid base that has some room to run.
And Maddie, we had a guest on about a month ago who made the same point as Gene did. Perhaps you just ripped the Band-Aid off initially from the beginning instead of wondering, okay, when are we going to start this trade war conversation 2 years down the line, 3 years down the line? So, it's out there. That is actually one known.
There's definitely been two sides, theories of President Trump's tariff policy. The first is that it was a negotiation tactic, and the second was a little bit more uncertainty and concern, especially as the tariff policies kept kind of escalating. Even overnight, there was headlines about pharmaceutical import tariffs. So now that those are kind of all off the table or just a little bit less impactful than we first expected, hopefully it's the former, that it is more of a negotiation tactic.
Yeah.
And what's intriguing too about the tariffs applied to China, it was 34%, it was 84%, it was 104%. You know why the 4? Because in the Chinese language, number 4, the Chinese word sounds like death. And that's why it's a bad luck number. That's why.
I did not know that. I learned something new.
I just was in Asia and I just learned that. So that's, now I'm learning it a second time. That's good.
Oh, good.
And I need reinforcement, so that's good.
But this is what's interesting. The market is expecting that companies are going to be challenged with this operating environment and what guidance is going to look like. Maybe it won't be quite as ugly when you think about stock prices because that is a known.
Yeah, I mean, I don't know, though, if the E is adjusting as much as the P right now. I still think that a lot of the Mag 7 might be richly valued. And really, all of the Mag 7 decline really started with the DeepSeek news. Right. And what was going on in AI, and maybe what was not going on in AI in terms of CapEx spending. I think that's one of the things to continue to watch with the Mag 7 in terms of the continued CapEx spending. Everybody's anticipating it. A lot of the companies are baking in revenue that are counting on that. If that slows down, you could see further compression in terms of some of these prices, despite the fact that you've gotten a relief rally today, as Gene said, mostly technically oversold. RSI is well below 30. Pick your poison on which indice. China's a separate issue right now. It's interesting. It's given back all its gains through the first quarter of the year. It definitely outshined the US market, but now that's a little negative for the year, excluding today. Interest rates are another area I think that's very topical. That flight to safety just hasn't occurred over the last couple of days, and there's some people that might say margin calls because of the fact that hedge funds had to meet some of those, or some foreign countries are starting to put pressure on the US indirectly by maybe selling some of our treasuries. So those are a number of theories out there. I think it's partly the fact that the tariffs are going to be inflationary, however this lands, unless you have no tariffs on each side or something reciprocal. But if it continues like this, you could see interest rates surprisingly continue to tick higher.
Yeah.
And one surprise out there we heard about is that Treasury yields are moving higher because China wants to, strengthen their dollar, strengthen their currency. Doesn't make sense, because if you want your currency, if China wants to weaken their currency, what they're going to do is they're going to buy treasuries, not sell treasuries. So we kind of discount that route. And I think the real perspective is what you said, is that there are some firms raising cash, selling treasuries to margin calls or some of the CTAs. So we're watching that extremely carefully. So, but I do agree with you, yields are going to move higher. We expect that. So.
Yeah, I think, Michael, a lot of it comes down to the consumer. I mean, that and employment are going to be the two biggest factors.
Right, and with the consumer, if you're following their sentiment measures, it's not looking great. We'll find out on Friday, get the updated University of Michigan numbers. But across the income spectrum, you're seeing that consumers are pulling back. I think it's also interesting if you look at the sentiment numbers based on party affiliation, because it has become pretty politicized. So even if you look at what independents are saying, they're tracking more the Democrat kind of sentiment, where they're feeling much more negative about the economy right now. So if that actually feeds through to spending, then that's where it's going to be a problem for the economy. Of course, the caveat being that the last few years here, consumers have said that they've felt terrible about the economy and they've kept spending like crazy.
But see, and that's where I think the challenge is, and it's going to be perhaps the inflation that occurred over the past 5 years, perhaps there's some, taking advantage of, in that particular environment. I don't know how well consumers are going to digest these potential tariffs that could be passed through. It's going to be a comms and PR issue for many of these companies as well. It's not going to be an easy decision because, all right, input costs are 10% higher. We're going to pass 10% cost on to the consumer. That's not going to be an easy decision for companies to make.
Right, and there are other ways to mitigate it, like you're talking about devaluing your currency can offset some of the tariffs. You can take some of it into your margins. You can pass some of it on. So it doesn't have to be that a 10% passes on fully to the consumer, but yeah, you're totally right. Consumers are sick and tired of inflation, and they're sick and tired of prices going up, and things are 25% more expensive than they were 5 years ago, and tariffs are only going to make that a bigger problem. So it's definitely, people don't have the same willingness to keep taking those higher prices on because all the excess savings that they had during COVID, that's gone. So they don't even have the cushion to take those higher prices on.
And Gene, I often think if we did not get that generative AI story in November 2022, which was a tremendous catalyst for the markets, maybe we would not have been at such extreme levels. Perhaps this is more reflective of
I think it makes sense. I think coming into this year, our perspective was we were expecting a correction. And we weren't surprised that we had a correction. We were surprised it took so long. You had so much optimism, you had enthusiasm, you had everyone was buying stock. My mom was calling me, she's saying, Gene, I gotta buy stocks. She's never bought a stock in her life. I gotta buy a stock. And so much optimism, and with a PE ratio of about 22 times forward earnings, you're a little bit pricing in everything perfection. And I think your comment about DeepSeek kind of hit that. That's a paradigm shift. Now you don't need this big chat GPT language if you're not NASA. If you're like Gene Goldman, you can just use a cheaper version. You're fine with that. You're getting the same insights. So I think those companies are starting to rethink this. But with that said, we are in a secular AI trend, and I do think if tariffs do stay high, if there's uncertainty, our favorite sectors are utilities. We still like healthcare, and we like selective in technology, the services side of technology, because AI is not going away.
Right. I mean, it certainly isn't. But you made a point about valuation before, in terms of the beginning of the year. The European and EM trade was significantly outperforming the U.S. markets because of the valuation. The risk was to the upside. So I think that was going to take place regardless.
Yeah, I mean, it's interesting. We're seeing inflows in our bear funds over the last couple of weeks. Why? In some case, to hedge gains, if they still have them after this move, to reduce beta and to take an outright short where they wouldn't be able to do otherwise through a package liquid ETF. But what's interesting is we've seen buying in the U.S. in terms of short-term traders thinking there's a rally, but we've seen inflows in, for example, our triple leverage bear on China, which is the triple leverage bear, the equivalent of FXI, the non-leverage, which is Yang. So we're seeing some traders getting a little more aggressive to the bullish side now. China to me is the wild card. Also look at copper prices. Copper has fallen out of bed. It hit record highs. Some people could say partly due to the fact that people were anticipating tariffs, placing their orders in advance. That market's starting to unwind. I really believe that if you look at copper, it better hold that $4 area. If it doesn't, I think you could look at China and probably say their equity markets are going to suffer as well.
Yeah.
So copper's not just for Moscow mules and pennies, right?
Yeah.
Economic.
Well, the Moscow mules are good. We'll all agree on
Maddie,
that.
another big story too has been the IPO market evaporating.
Yeah.
Once we get some clarity, let's call it, couple months from now, how is the pipeline looking? Because there was a lot of pent-up demand the past couple of weeks prior to the
just like the
tariff
major
tantrum.
indices, something that we are having trouble predicting is when the IPO market will reopen, when M&A will pick back up. We came into this year expecting M&A, a really robust M&A and IPO market. Volatility does have a really big impact on those markets. The VIX closed up above 50 for the first time last week, really since April 2020, which was the start of COVID. So we really need to see volatility come down to around 20, which will really hopefully have the appetite for IPOs come back. It's really not up to Nasdaq to determine when companies should go public. It's up to investors and when they are ready to kind of mitigate that risk and underwrite that risk.
But I think what also is encouraging with the pipeline is it's a multitude of sectors. It's just not one particular space like AI or robotics. It is consumer, healthcare, tech. It's pretty diverse.
Yeah, there's about 200 companies still on file to list here in the US. I think what we are seeing are some of the unicorns stall a bit with their plans to move forward and go public in the US. But once that market does open, we will see a really robust range of sectors move forward.
So Gene, to wrap up here, from a longer term perspective, how are you keeping investors above water and calm through what's been, a prolonged environment of volatility? We haven't seen this in quite some time.
I think we just go back to the basics. So in the last 45 years, the S&P 500 has been positive, 37 of the last 45 years. We have an upward bias, stronger economy, growing population, et cetera, et cetera. But in those years, in those 45 years, the average intra-year pullback, decline, loss is negative 14.1%. Volatility is a normal part of investing. The goal for our advisors and investors is to stay invested for the long term. Take advantage of these volatility moves. Don't market time, it doesn't work. But instead, take advantage of this volatility using products, alternative products, inverse products. Take advantage of the volatility.
All right, appreciate everyone's insight. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.